Welcome to this very special edition of the Mutual Fund Show. Now, the reason that we're focusing on your mutual fund investments in a more detailed manner on the show today is because of the carnage in small cap stocks that we saw in the markets yesterday. This has led to a lot of concerns. Investors, and probably you have this query: what do I do with all of my investments in small cap funds? Just for a couple of lines of context, small cap funds, specifically also mid cap funds, have been the favorite of investors, retail investors, over the last couple of years. Consequently, they're probably the most likely to have been hurt in Tuesday's fall. What do you do now? Is it time to review, relook, and what next? We have a host of experts to do this today, but first I'm going to go across to my co-host and colleague Alex Matthew, who's put together some very interesting data. Alex, I thought it's interesting to explain to people, you know, the context of the rout we saw yesterday and what it's going to do to portfolios.
No, certainly, and you couldn't have put it better. Let's first establish, of course, the fact that yesterday the benchmarks itself, so you talk about the Nifty Midcap 150 index, fell about 4%, and you had the small cap 250 index that fell over 5%. Now, with that in mind, all actively managed small cap and mid cap schemes saw cuts. On an average, small cap schemes saw cuts of about 4%, and mid cap schemes saw cuts of about 3.5%. But then, if you delve a little deeper, you will see that depending on the kind of approach that the fund manager had, some saw bigger cuts than others. So let's first look at the small cap space. These are the ones that have managed to limit the downside. So you have on the list the likes of PGIM India, UTI Small Cap, Axis Small Cap, SBI Small Cap, ICICI Prudential Small Cap, which incidentally was the latest to announce a stoppage in the lump sums that are coming into these schemes. We'll talk about that in more detail. These are individuals that had a more pragmatic approach and shifted portfolio strategy because they thought perhaps that valuations are a little stretched. On the other hand, you have those that lost more, and that's probably because of the kind of strategy or the approach that the fund manager has taken. Quant is a very popular name now. It is a scheme that has gotten inflows of over 8,000 crore rupees over the last 1 year or so, and it is in fact the worst hit in the small cap space, losing about 6% or 5.8%. A few of the other names, of course, some of them are familiar because these are outperformers from 2023. The last one on the list, Mahindra Manulife, did incredibly well, but it has lost as much as 4.4%. Quickly running you through the same list on the mid-cap space as well, and those that have managed to, or rather that have lost the most ground, you'll see a familiar name on the top, Quant once again, losing close to 5%, and that's again because of the strategy. We'll talk about what you need to bear in mind if you are invested in these. So run your eyes through this list, and then also the least hit in the mid-cap space. You'll see Motilal Oswal on the top. You'll again see Axis mid-cap because it's essentially the same fund manager, and that strategy essentially bleeds over. A few more aspects that you need to bear in mind. I was talking about inflows into these schemes, and you'll see an interesting data point next, which is the inflows as of January for the last 1 year. And Quant has gotten 8,100 crore rupees of inflows in the small cap fund. You have HDFC Small Cap that has gotten close to 5,000 crore, and Nippon India, which has gotten as much as 3,378 crore. And you have on the mid cap end Kotak Emerging Equity, which has managed to lessen the impact of yesterday's fall, which has gotten inflows of as much as 6,259 or thereabouts. So it's interesting. Tamanna was pointing out the kind of inflows that have come in, over 40,000 crore for the small cap category, and in fact a similar amount, not similar, but about 20,000 crore coming in for mid caps. Tamanna, a lot to talk about right now.
Yeah, absolutely. And you know, just to say that this data is one sort of snapshot of what happened yesterday. It's not a qualitative verdict on the quality of any of these funds and these fund managers. But clearly, if small caps are going to be under pressure, then the most successful small cap funds are going to be hurt the most. Having said that, Dhirendra Kumar, founder and CEO of Value Research, is our first guest on this special today. Dhirendra, great to speak with you here on NDTV Profit. You know, I think the big question, the number one question for viewers right now is what to do with their small cap holdings. SEBI has already set the stage to prep mutual fund players with the stress test, which actually you'll see the first iteration tomorrow, that what if there are redemptions, what are you going to do? My question to you on behalf of viewers is, should they even look at redemptions right now?
No, my sense is that, the stress test is faulty, and, stress test is a moving target. If the stress test was to be done yesterday, it would have, led to a far steeper collapse. Also, for small caps, the scale of turnover could be very different on different days, and it could mean nothing. And also there is also a kind of aberration in the stress test, that the speculative part of the set of stocks in which racketeering goes on in the market, that is where you will have great volumes, and you can have great stocks which are high quality small caps, where the fund manager is holding a position, where there may not be a turnover. But if he wants to sell 100,000 shares, 1 lakh shares, or 5 lakh shares of those things, he will be easily able to find a buyer. The market may not be visible in terms of traded turnover. So I think, stress test is basically activity mongering, and the quality of small cap portfolio has to be, this is where we have to go by the judgment of the fund manager. Undoubtedly, we find that there is a froth here. And froth is a very cyclical thing. Markets go up, markets go down, and when markets go up for a prolonged period of time, then excesses happen. I think, it will be more useful to find companies where the prices are getting rigged. Find companies where, operators are working actively or they are working overtime. Find companies which have no fundamentals and they are still zooming. I think they're far easier catch than actually, because my sense is that even if you pick the worst of funds, and if a fund manager is doing a little bit of value addition in terms of making sure that these companies will exist, or they exist and they make profits, and investors are doing their SIP, the risk is very low. And, if substantial flow into small cap funds are by way of SIP, you look at the fund which has lost most, I'm not saying that this is a judgment or this is an opinion on it. The worst performing small cap fund yesterday, or the second worst performing, was one of the, quant funds. And if you look at, despite that fall, as of yesterday, the 5-year SIP return was 48% annualized. Unless this fund loses 60% of its value, investors will still be happy with the fund. So I think, a lot of the risk is getting reduced by investors' action, the way they invest, and the diversification of a mutual fund the mutual fund as a diversified vehicle. So I would say that there are risks. Mutual funds are, market is made up of, equity funds will be cyclical, and take this in your stride. Yesterday was an extraordinary day, and this might lead to, a lot of maybe, if the fund manager choose to actually not accept lump sum money into their fund, that is fine. But SIP investor with a long-term view, I don't think they should worry. They should use this as an opportunity. They will be rewarded for all their patience, not their hyperactivity. I think the investors who are participating in small cap stocks directly, because market has been democratized by these apps anyway.
Yes.
I think they have something to worry. The worst of the lot would have been looking nicer, which would have looked nicer.
Yes.
They will be the worst affected, and they may not have a recourse.
Certainly. Dhirendra, Alex here. And to the point that Tamanna was making right at the start, and you also made this point, you cannot pass judgment based on one day's move. Having said that, perhaps you can glean something from the way that some of these funds and portfolios have moved, because would it be fair to say, Dhirendra, that over the long term, downside protection is, if not as equally important, perhaps more important from an active fund managing standpoint to beating the benchmark over a period of time? And would the losers then give you a bit of an insight as to which portfolios are protecting you on the downside?
Yes, that is the ideal situation. What typically happens is, I have seen that over a longer period, the great fund, they never turn out to be, the great performing funds over a brief period of time. They tend to be, ideal fund in my mind, and the funds which have proven that they have done very well for investors over a long period of time are the ones which fall little less in a falling market, and funds which are able to reasonably participate in a rising market. And you don't need to be a blockbuster. And if you are going to be a blockbuster, then you actually are assuming some risk which may not be visible right now. And that might be the case. But and most of the funds are actually reflecting that.
Dhiren, just simple base question for someone watching this and wondering if they're overexposed in small cap funds. Should they do anything at all, or wait for the system to sort of sort itself out and see what comes out of AMFI and SEBI actions?
No, I think this is time to actually, we in good times, we do the risk tolerance. Any advisor will actually go about doing that. But the day to do your risk tolerance was yesterday. If you did not lose your sleep, then sit tight and you can withstand this, because the only way to overcome this, because if you are investing in micro cap, if you are investing in small cap, and even if you are investing in a diversified vehicle, and if you lose your sleep, it is not worth it. Maybe it is time to take your portfolio exposure holistically, because what is happening is you will have some multi-cap fund, you will have some, flexi-cap fund, you will have a small cap fund, and then you will have some other thematic fund. Because, in this small cap carnage, we are missing out that the biggest loser yesterday were the PSU fund, which have been, the recent hottest segment of the market. And that also might be completely, misplaced, because many of these PSUs are actually lack of liquidity product, because they don't have enough liquidity and they can be easily rigged, or, action of some investors driving up the prices, which may not be sustainable. And over a long period of time, these, my understanding is that they are far bigger risk in the market than the small cap, because in small cap, you will have a couple of winners and you will have some big losers. And overall, over a period of time, you will do well. In case of these PSUs, they have proven to be a long-term loser for investors who have invested for 10 years and more. And that is my worry. Investors coming at peak is the most dangerous thing for those funds. And that is what, investors should, investors have very few things in their control. Diversification, a long-term orientation, and staggered investing, and not chasing recent past performance.
Right. Now, so coming back to the point, so thematic funds may need to be relooked at. You've marked out PSU funds, and thematic funds have been all the rage as well, Dhirendra, as we've spoken in the past. My question is, what is the right proportion of small cap exposure you should have in your portfolio right now?
It depends, it could be 30-40% if you did not lose your sleep yesterday. And it should not be, more than 5-7%. And you should not take any small cap fund. You should not make any small cap fund investment. Your flexi cap fund will take care of it. If you look at the average exposure of the flexi cap fund, it will not exceed 10-12%.
Fair point. I have a question on the other end of the spectrum, Dhirendra, because there are a few individuals that have perhaps too many small cap funds. And anecdotal evidence, conversations that I've had just over the last 1 week, this particular category is being sold very aggressively, perhaps because it's the easiest to sell. If you look at the 1 year, 3 year returns, it has beaten its peers or other categories handsomely. But what about those individuals in yesterday's fall that have not lost a very large amount? And I'm talking about individuals that have seen their equity portfolios drop by about 1.5% or thereabouts. And you say that you don't lose sleep, but are they taking enough risk?
No, I don't think so, because, there is nothing unusual about investors chasing recent past performance. That is investors' favorite pastime, more so when you have a roaring bull run getting into the 4th, 5th year. But the point is that, how much is way too much? And that, to my understanding, is never lose your sense of proportion. I think for most investors, it should not exceed more than 20-30%. If you own only small cap funds, then I think it is something to worry about. Yesterday's carnage, you should just take a lesson that, what if this continues or this prevails for a while? What if the market stops going up for a brief period? I think, that is something. My worry is about those investors who now have a very exaggerated expectation simply because they have never seen the other side of the market. They have never seen a
Dhirendra, that is
sideways
exactly
market for a long period of time.
Dhirendra, in fact, I was coming to exactly this point. You have a whole host of investors that have started investing in the markets, after the COVID lows, and they have easily gotten, 18, 20, 22% CAGR over the last 3 years comfortably. I met someone the other day who said 18% is not enough. I want 24% because my colleague, my aunt is getting this. So how do you benchmark your return expectations?
No, you can't do much about it because, not only these people are expecting that, these investors actually got that. When I was referring to this quant fund over the last 5 years, the SIP return happens to be 48% despite adjusting for yesterday's decline. It is no longer theoretical. It is real. People have realized it. Some people have actually realized it and bought their car or, consumed it or, spent it. And now we see a new level of, the wealth effect permeating in investors. But I think, a reasonable expectation will be that look at 10-year return, look at 5-year return, look at 15-year return. You will realize that, despite all the cyclicality, they are able to deliver more and don't have this, exaggerated expectation. But, I think there is something which is very unusual about the Indian market. The scale of SIP flows into all these funds, not just small cap. And the growth in the magnitude is unprecedented. And not only that, all the previous intermittent corrections has not been an occasion to sell. My worry is that this expectation, the level of market or the rich valuation of the market can only go up if foreign investors also start participating aggressively. The state of a small cap is, despite the fact that EPFO does not invest there, National Pension System money does not get invested there.
Yes.
Big DIIs don't invest here. Despite that, it is entirely driven by small investors flow into small cap funds or even mutual funds which are allocating some funds to derive their alpha.
Yes.
And I think this is where the alarming thing is, that you will be ready for prolonged period of non-performance with them if you have been used to the great performance of small caps.
Yeah, that's a fair point. Dhirendra, thank you so much for joining us and for laying the foundation for this conversation.
The numbers on where you can reach us if you have a query are going to flash on your screen in just a bit. And in this segment, we're going to get our top experts to answer your questions. And, at this point, we're getting a lot of questions, which I'm sure many viewers will have. So let me introduce first Hemant Rustagi, CEO of Wiseinvest, and Harshvardhan Roongta, CFP of Roongta Securities. Welcome to both of you, and thank you so much for speaking with us today. I'm going to jump right in and start with the query, because what better way to address people's concerns. Vikas has written to us. He's aged 49, and his goal, I really love this goal, is booking profits. Very clear. He's saying, I've been investing through SIP in 3 different small cap mutual fund schemes for the past 5 years. I would like to continue the SIPs for another 5 years. I booked some profits in 2021 and 23, and I'm still sitting at a profit of approximately 100% in all these schemes. Good for you, Vikas. Now, my question is, should I book partial profit? If yes, where to reinvest? Or should I continue my SIPs? These are the SIPs I've currently invested in. He's given those names. So HDFC Flexi Cap Fund has about 12,500 in it. HDFC Small Cap Fund 3,000. ICICI Pru Balance Fund 12.5. ICICI Pru Multi Asset Fund 5K, and SBI Small Cap Fund 5K. So quite a bit of detail over there. Hemant, I'm going to start with you because I find this particular query very interesting. People who are sitting on the kind of profits that Vikas is after already booking are wondering that if even the SEBI chair is talking about fraud, everyone's talking about greed, overvaluation, is it time for me also to take something off the table? If I do, where do I put it?
Well, Tamanna, I think that's an important point, clearly. I mean, we have discussed that and we all know that, yes, I mean, there are certain pockets of small cap, definitely there is overvaluation, so there are obviously concern there. But I think from the investor's point of view, the most important aspect is, one, what is your exposure level to small cap and the manner in which you have been investing today. So if there is someone who has been investing over the last few years through SIP and still has a time horizon of 5-6 years or even more, and wants to continue investing through SIP, and I would say the allocation to small cap, in fact, if I can combine even mid cap and small cap, is lower than what the exposure one has in the large cap. I don't think investors need to really think of booking profit, because there are always going to be phases, Tamanna, where you will see a certain segment of the market. If you go back, let's say 2 years back, only the large caps were doing well, only a few stocks were doing well, the market berth was very narrow, the returns were not great from mid cap and small cap. So I think you wait out those periods, you continue a process, so you will see certain time period where a certain segment will do very well. I think the most important thing is to manage your risk, as long as it is within your defined risk level. What I mean by that is that you're not investing aggressively into small cap, and you are having a very clearly defined time horizon, which still, like I said, is around 5-6 years or more, and you're investing through SIP. I am not someone who would recommend that every now and then you book profit, because then it all amounts to timing it. Second thing is, let's not forget, Tamanna, that you have given your money to the fund manager to manage it. If you see, many of these small cap funds have increased their allocation to both in cash as well as the large caps. Some of them are even as much as 20% in large cap and in cash. So I think the fund manager is doing that on your behalf. You don't have to necessarily do that in your portfolio.
I'm going to just take that question quickly to Harsh as well. The goal is booking profits, because that's coming from a place of nervousness. And while you want to trust your fund manager, you don't want to keep your eyes shut and hope for the best. What would you suggest?
So, well, Tamanna, while talking about the conceptually on the financial planning part, I concur completely with what Hemant has said. However, if you take Vikas's query specifically, so he's mentioned two things which are noteworthy. The first one being that his goal is profit booking. So he is essentially investing with the purpose of exiting and booking certain profits. The second part being that he's already undertaken this exercise once in the past, where he said that he booked some profits earlier. And again, he's looking to do that same exercise. So fundamentally, what Hemant is saying is perfectly correct. However, specifically into this case, I think there is merit if he's looking at profit booking at his goal and wanting to invest into another category. Well, he could book profits into a small cap fund and reinvestment. What was the next question was that if he was to reinvest, where should he? I think HDFC Flexi Cap is already in his portfolio, so he can most certainly increase the allocation to HDFC Flexi Cap fund. So yes, answering the question, he can book profit in, possibly he has an HDFC small cap and an ICICI small cap. So any one of the schemes he could possibly stop investing into and redirect that money into the HDFC Flexi Cap.
Okay, fair point. Gentlemen, hi, Alex joining in as well. We've got another question, and I think this lays the context and the foundation for another aspect that we need to talk about. Okay, so Prasad is asking, he's 36 years old, and his goal is to build a retirement fund, but he's also talked about certain other aspects. I'm going to read it out for you. He's got equity holdings of about 2 lakh, and he's invested in, I believe, a money back policy of 12 lakh of LIC. And he's also invested in the SBI Child Future Plan and Post Office Girl Child Scheme. He's looking at a few mutual fund options that he hopes will give him a good corpus for his 3-year-old's education, and also to have a retirement corpus of a minimum of 2 crore by the time he turns 55. So that's another 20 years away, which is quite a distance away. So Hemant, we're talking about individuals that have not necessarily bought in whole hog into the mutual fund space, despite the fact that you've seen tremendous SIPs, tremendous inflows. There are still people that have not yet gotten in and not yet seen the kind of returns that can potentially be generated. For those that have a corpus or have a SIP that they want to start right now, with perhaps your point of a little bit of froth in the market, how do they navigate it now?
Well, Alex, I believe that someone, like in this case, we're talking about a long-term horizon. Both the goals are important, the child education as well as retirement. There's a very real long-term time horizon here. My belief is that, someone who's starting to invest, first thing is your focus should be in trying to understand equity as an asset class, which obviously is not something that you get to learn overnight. It takes time. So what best you can do is, one, you need to be having a clearly defined time horizon. Second is that we need to invest in a very disciplined manner. And I think that's what we are seeing. Most of the investors in India now investing through SIP. So having said that, if you were to look at the categories, I think there are 2-3 categories which I believe as a combination can work very well for a long-term investor. One is obviously a flexi cap fund, because these are the fund where even though the fund manager has the flexibility of investing in any segment of the market, but most of these funds are actually having a bias towards a large cap. The second is large and mid cap funds where minimum 35% has to be invested in each of these segments, and the remaining 30%, again, in most of these category of funds, if you see, is invested in the large cap. The third is the multi-cap fund, where the minimum of 20%, 25% has to be invested in all the 3 segments, and the remaining usually again goes into large cap. So I think when you invest in a combination of this, it's very important. One, like I said, have a defined time horizon, invest systematically, and also to make sure that you have a representation of all the 3 market segments in your portfolio, but with a bias towards the large cap. And the second, the fund manager should have the flexibility to change the allocation. At the same time, you as an investor should also have some say in defining how much allocation you would like to do. So I think the combination of these 3 categories, I think, works out very well for someone, even if someone is starting to invest in equity funds now.
Fantastic. Harsh, last quick view. Unfortunately, we're running out of time here, but do you want to add anything to that in terms of schemes that he can look at in terms of allocation towards fixed income plus equity?
Yes, Alex. So, looking at his query, he got 2 lakhs into equity, 12 lakhs into an insurance policy, which is an investment oriented. I don't know the SBI Child Investment is a mutual fund solution oriented product, or is it some ULIP or an insurance policy? The PO, the Post Office Girl Child Investment that is referring to, I believe, is the Sukanya Samriddhi Yojana. Nevertheless, I have only one simple advice for him, is that you need to look at equity as an asset over long term. So he's got a girl child who's 3 years old, requires money for higher education, which at least there is 15 years time horizon, and his retirement itself is 20 years. So there has to be some thought gone into saying that we want to invest into assets which are growth oriented, which have the potential to beat inflation over a longer period of time. Though there could be volatility in the short term, but you need to create wealth by beating inflation. So his allocation will need to go more towards equities now, here on. Whatever he's done till now, I'm not commenting on that part. However, here on, any additional allocation that he's making should be through an SIP into probably a flexi cap or a large mid cap or a multi cap fund, as Hemant has suggested. And it could be for long term. So he has to just have the discipline, patience, conviction, and look at investing into Indian growth, which is via mutual funds through SIPs.
Fantastic. Thank you so much, Harsh, for giving us that view. Hemant as well, thank you so much for joining us on this program. We've got Shalini Dhawan joining in, and we've also got Aditya Nain, who's author and professor, and they're going to give you some perspective on how to react to yesterday's move and also the rebound that you're seeing today. So the first question, Shalini, to you, is that a lot of people have seen cracks in their portfolio, but then if they look at their portfolios once again at the end of today, it won't look as bad. So, of course, one day does not change your investment thesis or your journey, but should you take something from yesterday if you are skewed too much in one direction?
Yes, thanks for having me, Alex. Surely, I mean, over the past some time, maybe many months, I think there are some lessons to learn. What we are seeing is a lot of investor interest, especially in small and mid-cap schemes. If you see some of the folios that have got created in this calendar year as well, the run-up in that. What we do understand is that valuations for small and mid cap are looking, expensive if you take long-term averages. So that's one caution. We also had some bit of caution from the market regulator asking small and mid cap schemes to actually disclose a little bit more data Also, there's a stress test which they need to disclose about every 15 days, and the first results of that are going to come out tomorrow. So I think all these items are trying to caution the investor that while the recent returns have been, superb, there also is, valuation data, fundamental data. They need to understand and be a little bit cautious when they're trading into small or mid cap, or if they're already holding small and mid cap, because they have been excessive in terms of the returns and the valuations.
Okay, fair point. Interesting point to take this next question. Aditya, this one's for you. Chinmay is asking this question. He's saying that someone told him to exit small cap funds. He's got 3 SIPs in ITI small cap fund, SBI small cap fund, and HDFC balanced advantage fund. He's asking whether he should stop his SIPs into small caps.
Firstly, I would say, without knowing much more than what's on the screen, no, it's usually not a good idea to stop your SIPs even if the market is high. That's one of the point of an SIP, right? That if the market is low, you still continue to get your units at a lower price than you did, let's say, last month or the month before that. But the more important question, I think, is to figure out whether they have anything else apart from the small caps. Because it's shocking how many people get in touch on social media with me and say, I have X, Y, and Z small cap fund and nothing else. So if they have nothing else apart from small caps, it may be a great time to relook at your asset allocation and diversify well. Put those large caps in, put those mid caps in, and so you have a well diversified portfolio. If you're someone who gets really scared of market drawdowns or market crashes, then consider whether you want to actually add, let's say, 10 or 20% of fixed income in terms of a debt fund or an FD or whatever that may be. But stopping the SIP just because the market is high, I don't think that's a great idea, especially because they're young and they have a long investment time horizon ahead of them.
We've been taking viewer queries, and I think some of these set the stage for the conversation that we're having. And one question that we've got is from Dhriti. She's saying that she's invested in ICICI Prudential Small Cap Fund, and she's got a lump sum investment of about 3 lakh to invest in the next 5 years. Where to put it? It's an interesting question, right, Aditya, because you have some of these schemes, including the ICICI Prudential Small Cap Fund, which has stopped lump sum inflows. If you are looking to invest for the next 3 years, perhaps you should look at staggering it, right? That's the pragmatic approach. But how do you do it? Do you start an SIP or do you look at something like an STP? How should you go about it?
So my preference for this is usually pretty clear. That means you want to go for an STP for the reason that it gets the money out of your bank account and you don't spend it on things that are unnecessary. So you move the money from the bank account to a nice, liquid fund, ultra short duration fund, safe debt funds. Use those as holding funds so that even if the markets have ups and downs, your capital is protected, and then phase it in over the next 6 months to 12 months, where every month a set amount goes from your safe debt fund into your equity funds. That could be a diversified equity fund. It could be, flexi cap, multi cap, or you could have specialist funds for large, mid, and small cap as well. Both those options are fine. So my preference would be STP. But if someone is not sure about, hey, what's this SCP? I'm not sure how it works. And SIP is a good alternative as well.
Okay. Do you want to suggest, if not the scheme, but perhaps the category? If somebody is 29 years old, so relatively long horizon, they're talking about building a fund that will give them regular income down the road. Do you want to suggest something?
I'd say 2 categories stand out. One is a flexi cap. So your target equity fund can be a flexi cap fund. The other could be a multi cap fund. These days, I'm also talking more about multi asset funds, because for some people, knowing that you have a little bit of cushion in terms of debt and also some gold in your portfolio, in your fund, makes them feel better, especially for new investors or slightly inexperienced investors. So flexi-cap, multi-cap, or multi-asset allocation funds would be a good option.
Speaking of young investors with perhaps not a lot of experience, we've got Anuj, who's 24 years old, who's asking a very simple question, Shalini. Where can I start an SIP for this year? Will small cap funds give good returns this year? So particularly for a 24-year-old, you're talking about the next 40 years that are, maybe 35 years that are available to invest. Of course, small caps from that perspective, given the horizon, are a great avenue. But if you're starting out right now, what should you do?
So I think for Anuj, who's so young and I'm assuming a newer investor, I think the building the investing experience, building the discipline via a monthly SIP is of prime importance. How and what kind of returns small cap or mid cap funds will give in the next 1 year is a guessing game, because they are sitting on already given higher returns. So if you just take the simple theory of reversion to mean, you would expect mathematically that they may not be poised to necessarily give high returns. Having said that, it's really crystal ball gazing. So I think in terms of scheme selection, if this was really one of his, starting investments, I would actually suggest a mix of equity and debt by way of, like a balance advantage fund or a multi-asset fund, like what Aditya suggested. If he's comfortable, he can probably take the next step into a passive scheme like an index fund, which is also fairly low cost for him. And he could look at whether if he's looking at equity schemes, then he needs to look at a longish horizon, which he does have. He's age 24, so he does have age on his side. So yeah, I mean, starting with something more like a balance advantage fund or an index fund would be something that may help build his investing experience.
Certainly, 24 is a great age to start. I wish that I had started at that age. I say this often, and I mean it wholeheartedly. Thank you so much, Shalini, as well as Aditya, for joining in and giving us the perspective that you did. Viewers, I think the crux of the conversation is that your investing journey is not made or broken in a single day. And perhaps yesterday's move is time for you to reflect on how your portfolio reacted and your comfort level in terms of the drawdown that you might just have seen. Of course, quite a bit of that might have been erased already as we speak. We're turning back to the markets in just a bit, so do stay tuned. This is NDTV Profit.